Hello, it's Thursday, December 28th, 2017. I'm Steve Houston with Compass Communications, and I'm here again with Joe Terril, founder of Terril & Company, to chat a little bit about the markets and investing. And Joe, 2017 is closing out. How's the world economy looking, and what do you see for it in 2018?
World economic growth has actually picked up during 2017. It's accelerating as we move into 2018. We're seeing growth in Europe for the first time in many, many years. We're seeing very nice growth in Japan, who basically has had a flat economy for 10 or 15 years straight. So world economic growth is doing really well. The United States is accelerating somewhat, and would think at the moment we're running 3.5%, maybe even as much as 4% GDP growth. Would be very confident that that type of growth is going to continue as we head to 2018.
Okay. Well, everyone, of course, has heard of the big tax overhaul plan that was just signed. But what do you think its biggest impacts are going to be on the markets?
On the investment markets, I think all of what's perceived as good news has already been priced into the markets. The markets rallied basically from October, November, December, have had very nice rallies on the expectations that the new tax act is going to be somewhat of a windfall for corporations, and even international corporations doing business in the United States. The actual tax bill that passed, that's open to judgment as to just how big of a advantage the new tax bill is going to be for corporate America. So I don't see in 2018 the market at all reacting to the tax bill, if you will, as Wall Street does many times. They've already discounted that. That's quote unquote old news.
Interesting. So given all that, what is your outlook for 2018 in the investment markets?
It's going to be very fascinating, but we're entering 2018 in a very cautious mode about investments. Not because world economies are not doing well and the United States economy is not doing well, it is. But this economic growth is now beginning to spur inflation. And if you back the clock up to 2008, 2009, 10, 11, when the United States did quantitative easing, every industrial country around the world printed money to provide liquidity to get over the crisis of 08, 09. That printed money can be very inflationary as it begins to circulate in economies. And that's what we're seeing happen right now. So the reason we're cautious is as world economic growth is beginning to accelerate, you're beginning to see inflation go up all over the world. As inflation goes up, interest rates will follow and will go up. There was an article in last weekend's Wall Street Journal that was very interesting, and it was pointing out that in India, inflation's now running over 5%. It went on to say the Central Bank of India would like to continue to be very accommodative with monetary policy, but they're not going to be able to because of what's happening with inflation. Their hand, if you will, is going to be forced, and they're going to have to raise interest rates. Consequently, the bond market in India fell sharply over the last 2 to 3 weeks by almost 15%, and that's just the beginning. So what you see happening in India will, during 2018, begin to play out in Europe, begin to play out in Japan, and I think it's also going to play out in the United States, Great Britain, and other countries around the world. You can't, in the United States, I was talking about our GDP growth running at 3% plus, our inflation rate now, as shown by the last couple of months, is running at about a 3% annual rate. You can't run inflation at 3% while you hold interest rates at 1.5%. So the reason we're very cautious about investment markets is just that. Bond prices, which are dependent upon interest rates staying down, not going to happen. You're going to, sometime during 2018, see a real calamity in worldwide bond markets as rates go back up and bond prices get crushed. Now, stocks have enjoyed a phenomenal run since the economic crisis, predicated upon the fact that there was no alternative, because interest rates were zero all over the world. World capital flows into stocks. What else are you going to do with the money? So we are cautious as we head into 2018 on stocks, because as interest rates go back up, will some of that money now begin to go back to where it, quote unquote, was normally invested and come out of stocks? And then if you throw in an additional fact that if you believe inflation is going higher, which we do, until central banks around the world that are behind the curve in draining money from the economy, if you believe that inflation is on its way, and you can see it every day all over the world in any of the figures that are being released, I wonder, are corporate profits going to struggle as the cost of labor, the cost of money, the cost of materials, the cost of services all go higher? We haven't seen that in corporate America. How many years, Steve, has it been since people have had pay increases? People were more worried about, I just want to keep my job, I'm not worried about a pay increase. That's all behind us now. And employment around the world is at a high all over the world, and unemployment is at a low. So I'm glad to see this, by the way. We're going to see a different 2018-19 than what we've seen before. And I just think it's a good time to be cautious as you see, will higher inflation force central bankers to raise higher interest rates? Higher maybe even than what they want to? I think the answer is yes. Will higher rates of inflation and higher interest rates begin to have an effect on stock markets that are selling at 20 times earnings, all-time record highs? Yes. They can back off to say, 17.5 times earnings is still a pretty good multiple. But if they back off from 20 times earnings to 17.5 times earnings, that's a 15% plus pullback in stock prices. So the stock market in the United States is not unique in that it's rallied. If you look outside the United States, stocks in general have rallied even more than they have in our markets. And it's been a spectacular couple of years for stocks. But it's been predicated upon low inflation, low interest rates. Believe it's coming to an end. And therefore, it's a great time to be very cautious about your investments.
Interesting, Joe. As always, great insights. We've been visiting with Joe Terril, founder of Terril and Company, independent wealth management with $760 million in discretionary assets under management. Joe, have a happy new year.
Steve, same to you, and wish everybody a very happy, healthy, and prosperous 2018.
Thank you for joining us. We'll see you in 2018.